Artificial intelligence is often framed as a future problem, something that will eventually reshape finance, but the truth is it already has. The shift didn't arrive with a single announcement or disruption. It crept in quietly, embedded inside algorithms that decide who gets approved, what gets flagged, and how money moves faster than people can react. Most people think of finance as numbers and rules, but increasingly, finance is becoming a system of predictions, probabilities, and automated decisions made by machines that never sleep and never hesitate. At first, AI entered finance as a tool for efficiency. Banks used it to detect fraud faster, approve loans quicker, and manage risk more accurately. Trading firms used it to analyze markets at speeds no human could match. Credit card companies used it to identify suspicious behavior before losses occurred. On the surface, this looked like progress. Fewer errors, faster service, lower costs. But beneath that efficiency was a deeper shift. Decisions that once involved human judgment were quietly handed over to systems trained on historical data, patterns, and probabilities. And those systems do not ask whether the outcome feels fair, only whether it fits the model. This matters because finance is not neutral. It shapes access, opportunity, and stability. When AI decides who qualifies for credit, who gets better interest rates, or who is flagged as risky, it doesn't just reflect the economy, it actively reshapes it. For example, companies like Upstart, a lending platform backed by AI models, use machine learning to approve or deny loans. Upstart claims it can expand credit access by analyzing alternative data, but critics have found that its models can still reproduce biases present in historical lending. Rather than eliminate inequality, the automation sometimes updates the logic of old exclusions into new code. Similarly, big tech companies are embedding AI into the backbone of lending decisions. PayPal uses AI to evaluate transaction risk and to set credit lines for its pay-in-4 and working capital products. Users experience this as instant approval, but behind the scenes, it is a model determining not just whether you get credit, but how much, with little transparency about how those choices are made. The same goes for Square's Cash App and Apple's Apple Card, which use algorithmic scoring to determine credit limits. When individuals ask why they received lower limits than expected, the answer is often proprietary model, which means the decision is opaque rather than explained. AI has also transformed investing, especially at the institutional level.